Time now for Three Stock Lunch, and we're sipping on some big movers of the day. FedEx higher after announcing it's hiking its annual dividend by 44 cents and consolidating its operating structure as well. United Health higher on an upgrade to strong buy at Raymond James, and C3AI on pace for its worst day ever after short seller Carisdale Capital accused the firm of accounting irregularities. Here to help us trade all three names is Courtney Garcia. She's Senior Wealth Advisor at Payne Capital Management and a CNBC contributor. All right, Courtney, let's start with FedEx.
Yeah, FedEx, I have a buy on here. There was some very positive news that came out, which you alluded to, but basically they're going to be merging their ground and express businesses moving forward. And the reason that's so important is because it's really going to lower their costs moving forward. And this is going to be lowering costs by 2025, about $4 billion, and another $2 billion by 2027. And that's on top of some of the cost cutting efforts they already have, like cutting some of their employees. What's interesting is this is going to become a lot more similar to the way that UPS, their biggest competitor, is structured. And interestingly enough, UPS has unionized workers, which means that they're paid about twice as much as FedEx, yet their profit margins have been superior. It's likely because they're more efficient. All their businesses are together. And I think that just goes to show how much more upside there is for FedEx now that they're going to consolidate businesses like this. And add on top of that, they just increased their dividend by another 10%, which is always a good sign.
Look at that, up 1.75% today. Nice to see you, Courtney. Let's go to United Health.
Yeah, United Health, I also have a buy on here. I think what you're seeing with United Health is a couple things. Number one is there were some concerns that the changes to Medicare were going to be a headwind looking forward for United Health. It does look like that's actually going to be a little bit more beneficial than had previously been feared, so not as much of a headwind. They also had a recent acquisition of Change Healthcare, which is going to benefit Optum, which is one of their big growth drivers moving forward, as you have some cost synergies there. But largely, you've seen a pullback here this year with United Health and healthcare industry in general. After there's a lot of optimism last year, these things did very well, and there's been this rotation out of this space. But I think the fundamentals continue to look strong, and I think a United Health would be a good name to play here.
Final name here, C3AI.
I do have a sell on. There was news out today, which you had brought up, but there were accusations that there have some questionable accounting methods kind of to boost what their margins are looking like. I don't want to comment on that too much, but that is why it's down so significantly today. I think the bigger concern is this is a company that's up over 90% this year. It's had a really good run, but it is not profitable. It doesn't pay a dividend, and that's really not the kind of company that you want to be in currently. And when you do look at some of their customer acquisition and the fact that as customers are ending their trial period, they're not signing on for larger contracts, I don't think that's the kind of company that you want to be in right now.
Courtney Garcia, so good of you to join us today. Thank you.